Hello and welcome to the half-year update for Arena REIT for the 6 months ended 31 December 2013. The last 6 months has been a particularly active period for Arena REIT since the fund was IPO'd back in June 2013. There have been two major transactions which have grown the size of the portfolio by about $90.5 million. The fund now has total assets of around about $331 million. The first transaction was completed in November last year, and it involved the acquisition of 14 early learning centres, and they were acquired in conjunction with Affinity Education Group, who are also acquiring the business operations of those centres. And we were able to negotiate with Affinity to put in place our new 15-year Arena REIT lease. We acquired those properties on a bit over a 9% income return to the fund. Affinity, it's worthwhile pointing that they themselves listed on the Australian Stock Exchange in December at about $1 a share, and they're currently trading, I think last time I looked, about $1.50. So it's been quite an extraordinary period for them in terms of their share price growth. But I think it also reflects the interest there is in the childcare sector at present as well. The second transaction was the effective acquisition of 6 large-scale medical centres leased to primary healthcare. Investors, we had an investor vote in December, and investors approved this transaction, and that was of about $55 million of medical centres acquired on a yield of about 8.9%. So again, quite attractive long-term leases. Primary healthcare, as you're probably aware, are an ASX-listed company with a market cap of around about $2.5 billion, so a very, very strong quality covenant tenant. Elsewhere in the portfolio, it's been business as usual, and we've been progressing the leasing up of a couple of vacant properties we've had, and we've leased one of those on a new 15-year lease at Hervey Bay. We have 2 other centres which currently have term sheets signed, and we're in the process of legally documenting those 2 centres. We've acquired 3 development sites, additional development sites. That's on top of the other developments that we have in progress at the moment. And we also sold 2 properties during the period as well. So it's been quite active. If we look at rent reviews on a like-for-like basis, we've had rent review increases of about 2.7%. And if I look at the valuations, the revaluations which were done at 31 December, we had about a 3.6% increase in the underlying property valuations. So those numbers are pretty steady and strong, steady numbers. As a result of the revaluations, the net tangible assets per security of the fund has now increased up to $1.03, and you may recall that was at about $1 back at the time of the IPO about 6 months ago. And also gearing with all the acquisitions which have gone on at the end of December was about 24.8%, but that will increase up to about 32.5% post the redemption offer that we had for Sydney Healthcare, which we paid out in January. So currently our gearing is about 32.5%, but that's still well below our target range of 35 to 45%. So we still have plenty of capacity for acquisitions and also developments. We have something like about $10 million worth of developments on the go at present. That gives us further acquisition and development capacity of about $22 million left at this point in time. Just looking at the property market more generally, and we're not seeing any signs of a slowdown anytime soon, particularly with low interest rates. And I'd have to sort of say, especially in the childcare and healthcare sectors, where there is quite a tight supply and demand situation, we're seeing the markets there quite tight. So we're not seeing, we're looking towards forecast revaluation growth going into the next 12 months. One other thing we're keeping a close eye on is the Productivity Commission inquiry into the funding for childcare and early learning. It's something the government is currently undertaking, and we'll keep a close eye on that, and the findings for that report are due out later this year. Okay, so just now turning to the financial results for the 6-month period, and probably the most important number to report to you today is the underlying earnings per security number, and that was 4.1 cents per security. That was pretty much in line with expectations for the period, and it represents a 7.6% increase over the same time last year, so quite a healthy increase over the prior year. But based on these good results that we've talked about here today, the Arena board has now announced that we'll be upgrading our distribution guidance for FY14 to 8.75 cents per security. That was from 8.65. and I think that reflects some of the good performance we've had through the portfolio for the 6 months, reflects some of the acquisitions which have obviously gone on as well. If I just take you through that and what that means, I think it's a 6.7% increase over what we'd previously advised you of 8.2 cents, and it represents a 15% increase over the last year's distribution that the fund actually achieved. So if you look at if you look at it on an annualised basis, that's equivalent to about a 9.3 cent per security annualised rate of distribution. And if you look at the ASX price at the moment, I think it's about $1.11, and 9.3 cents over $1.11 gives you an income return of about 8.4 cents with tax advantages. So we think that's quite attractive to investors at the moment. That's pretty clear. So we've been pretty happy with the progress we've made to date over that 6-month period. We're happy with the performance of the vehicle. If there's additional information that you're wanting to find on the half-year results, you'll find the statutory accounts on our website. You'll also find the webinar presentation, which is available. And lastly, if you still have questions after you've read that material and gone through that material, please email me, and we'll endeavour to get back to you with a response to your queries as soon as possible.